Hello and welcome to another stock analysis on Stock Market Palantir. Don't forget to put your comments and subscribe. Okay, now let's go hear our analysts.
Welcome to the Stock Market Palantir. Today, we are going to talk about BBD.
And specifically, we're looking at Banco Bradesco SA because the volatility we've seen this week has been pretty intense. It really forces you to ask some fundamental questions.
Absolutely. As of the close on December 5th, 2025, BBD shares finished at $3.31. Now, what's really significant here is that jarring single-session decline of nearly 8.82%.
And that wasn't in a vacuum. This happened while we saw this huge institutional capital flight. I think the estimate was around 4.8 billion reais pulled from the Brazilian stock market in just a few days.
Exactly. So that sharp drop confirms this critical divergence in how the market sees the company. On one hand, the bank itself reported pretty resilient Q3 earnings. The EPS was, 11 cents? It actually beat the consensus estimates.
Right, but the price action is telling a completely different story. It just screams panic. So that brings us to our central question for today. Is this sudden repricing an unwarranted overreaction creating a huge, deep value opportunity?
Or is it a totally justified response to some very real, inherent structural weaknesses, confirming that Bradesco is in fact a classic value trap?
And I think you know where I stand on this. I believe the repricing is absolutely justified. It reflects a legitimate concern about BBD's structural weaknesses compared to its peers. And all this recent volatility just magnifies that chronic Brazil risk premium.
And I see it differently. I think the market got spooked by macro noise and, frankly, threw the baby out with the bathwater. I'm going to argue that BBD is oversold and represents significant deep value right now, priced for a disaster that I just don't think is going to fully materialize.
Okay, well, let's hear the case.
Let's lay out the case for deep value then. If we just look at the underlying health of the bank, despite all this chaos around the ADR, Bradesco is still a fundamentally robust, highly profitable, cash-generating machine. The Q3 2025 report confirms that. But the valuation distress it's palpable. The stock is currently trading at a price-to-book ratio of only 1.06. For an established bank of this size, trading barely above its liquidation value, that's usually reserved for companies facing a genuine existential crisis.
Okay.
To me, this suggests a totally irrational response to external volatility that just ignores the operational health of the bank. And what's more, for anyone with patient capital, there's a clear floor here. The company declared a pretty significant special dividend, around 5 cents per share, payable in May 2026. At this depressed price, the yield you get is just far too attractive to ignore.
See, I'm sorry, but I just don't buy that the low PB ratio is some kind of irrational market error. The reason that PB is 1.06, especially when you contrast it with its closest competitor, Itaú Unibanco, which trades at a PB of 2.01, well, that reflects a legitimate structural concern about BBD's quality and efficiency.
But double the PB.
Yes, bubble. The market is willing to pay nearly twice the book value for Itaú for a reason, and you can see it right in the operational figures. BBD's return on equity is hovering around, 16.1%. That's significantly lower than Itaú's 21.8%. That quality gap is the key. That difference means Bradesco is just inherently less efficient at using its capital to generate profits. It proves BBD has a major legacy cost problem. They're still burdened by this huge, expensive physical branch network. And all of this is before you even get to the permanent structural headwind from fintechs like Nubank, which are just eating their lunch in the mass market segment.
I see the points on efficiency, but that doesn't fully account for the severity of the recent drop. You're right to identify the perfect storm of external shocks that drove the selling pressure. Let's look at the geopolitical side first. You had this sudden threat of unilateral U.S. tariffs, anywhere from 10 to 49%, which creates immediate credit risk for BBD.
Right, because it threatens the cash flow of their big corporate clients in the export sectors. If those tariffs hit, those companies could default, and that risk lands right on Bradesco's balance sheet.
Exactly. And then compounding that, you had major domestic political fragility, with rumors about Flavio Bolsonaro's 2026 candidacy. That immediately sent the Ibovespa index crumbling and just massively expanded the perceived Brazil risk premium.
Precisely. And those dual crises, the trade war fears plus the internal political mess, they justified the flight of foreign capital. When political uncertainty spikes like that, sophisticated investors have to adjust our DCF models. They have to plug in a higher, more punitive risk-free rate. So as the cost of equity goes up, the present value of Bradesco's future earnings has to fall. That 4.8 billion reals exodus just confirms that institutions were forced to sell their most liquid proxies for the Brazilian economy, and Bradesco, with its higher GDP beta, naturally took the brunt of it.
Okay, while that 4.8 billion figure sounds alarming, the fact that the selling was indiscriminate across the board actually supports my overcorrection thesis. I see why you emphasize the impact of the shocks, but let me offer a different take on that punishing 8.82% drop. I think the market is aggressively confusing correlation with causation here. A huge factor in the dollar decline we saw is actually a mechanical currency pass-through effect, not a pure judgment on the bank's operations.
Explain that.
Well, when foreign investors flee, the Brazilian real depreciates sharply. Since the NYSE ADR price is mechanically linked to the local share price, divided by the exchange rate, a weaker currency acts like a double lever, pushing the price down. The stock looks cheaper in dollar terms, even if the underlying asset value in reais hasn't changed nearly as much. So if this political crisis is averted, or if the tariffs are milder than the worst-case scenario being priced in, the stock is mechanically positioned for a very steep mean reversion.
That is a compelling point about the currency effect, but it doesn't really address the quality and the mechanism of the capital that's exiting, which I would argue is even more bearish. This isn't just simple selling, it's hidden aggressive selling. If you look at the market structure itself, the off-exchange short-volume ratio went over 56% in early December. Institutions are using dark pools, private trading venues, to cross these huge blocks because they're afraid of liquidity just evaporating. They do it to hide their intentions. When over half the volume is traded that way, it tells you that the smart money is profoundly bearish on the near-term macro outlook, and they are getting out while they can.
I think we have to be very careful about how we interpret that 56% number. It's easy to see that and assume it's all massive directional bearishness, but the reality of the ADR market is a lot more nuanced. While some of that is definitely directional selling, a majority of that high ratio is driven by simple arbitrage activity between the NYSE ADR and the local B3 shares.
Okay.
High-frequency trading firms are just capitalizing on price discrepancies caused by the currency volatility. They'll short the more expensive leg, which is often the ADR, to lock in a risk-free profit. And the rest of that volume? That's market maker hedging. They have to short the ADR to facilitate the institutional selling without completely crashing the public price. It's more of a protective mechanical action, not a pure bet on Bradesco's collapse.
Well, whether it's hedging or speculation, the outcome is the same. The stock is structurally prone to greater downward pressure. And the very fact that this hedging is necessary speaks volumes about how severe the institutions believe the risks really are.
The mechanical pressure is clear, but let's shift in the behavioral side. How the retail investor sees all this. We have to address the widespread confusion about corporate actions, which adds to the volatility. There's this persistent reverse split myth about Bradesco. To be clear for everyone listening, Bradesco has not done a reverse split since 2001. What they do is the opposite, a regular bonification or stock bonus. It's value neutral, but it's very poorly understood.
And you're right to clarify that, but this exact confusion is what feeds directly into the value trap narrative for anyone who isn't a professional. We see it on retail forums all the time. An unseasoned investor sees the mechanical 9% price adjustment on the X date, and they panic, thinking it's a phantom crash. It shows this fundamental information asymmetry that smart money can and does exploit.
That's fair.
And it gets worse. This complexity extends to their dividend structure. It's often paid out as interest on capital or JCP. Now, this is mainly a tax benefit for the bank. For the investor, though, it carries a mandatory 15% withholding tax. So that high gross yield you see quoted online is significantly overestimated by most retail investors. They're expecting an income stream that they just don't fully receive, which only deepens that value trap perception when the cash doesn't show up.
You raise crucial points about the tax drag and the retail pitfalls. I acknowledge that. However, the fact remains that BBD's core banking business is sound, and the price is just too cheap. I still maintain that its current valuation, especially a PB of 1.06 and a PE around 9, it prices in a level of systemic disaster that the bank's own earnings just do not warrant. For patient investors who can weather this short-term noise, it's a value proposition, especially with that May 2026 dividend acting as a buffer.
I just can't get there. I have to conclude that right now, Bradesco is best viewed as a macro derivative. It's a liquid way to trade the U.S.-Brazil geopolitical landscape, not a pure investment in banking. The structural quality gap relative to Itaú, its exposure to a vulnerable domestic market, and the severity of these external shocks, they all mean that the high-risk premium is justified. The volatility will persist until we get clarity on tariffs and politics.
And I think this discussion really illuminates the core tension here for investors. You have to weigh a justifiable risk premium, driven by very real shocks, against the underlying fundamental strength of a bank at a historically distressed valuation. The challenge is deciding if those risks truly outweigh the evidence of an oversold stock.
Absolutely. And there is certainly more to explore here, especially around how these huge legacy institutions can ever truly overcome their structural problems to warrant a higher multiple in this new environment.
Thank you very much for hearing us. Let us know in the comments what is your opinion, and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.